Let me describe two people to you, and I want you to tell me which one sounds more financially responsible. Person 1 works hard, avoids debt like the plague, pays cash for everything, and proudly says, "I don't owe anyone a dime." Person 2 is worth $200 billion and is drowning in loans, borrowing millions upon millions of dollars year after year on purpose. Now here's the uncomfortable part. Person 1, the responsible one, the one who does everything your parents taught you, hands over a huge chunk of every paycheck to the taxman, works until 65 and hopefully retires okay. Person 2, the one buried in debt, might pay a lower effective tax rate than a school teacher, gets richer every single year, and passes on a fortune to their kids. And if your first reaction is, "That can't be right, debt is bad, rich people don't need loans," then congratulations, you're thinking exactly the way the system needs you to think. Because here's the thing, the wealthy don't see debt the way you do. To you, debt is a trap. To them, debt is a tool, and today I'm going to show you the exact machine they built with it. It has a name, and once you hear it, you'll never look at money the same way again. It's called buy, borrow, die. 3 words, and I promise you, by the end of this video you'll understand it better than most financial advisors do. You'll know why it's perfectly legal, and most importantly, you'll know which pieces of it you can actually use in your own life, even if you're nowhere near rich yet. But first, let's expose the trap that everyone else is stuck in, because you can't appreciate the exit until you see the cage. The way normal people get money for life, for a house, a car, an emergency, retirement, follows one script. You earn income, the government taxes it immediately, and you live on what's left. If you've invested and you need cash, you sell your investments, and the government taxes that too. It's called capital gains tax. Earn, get taxed. Sell, get taxed. Every single time money moves toward you, a slice disappears. Now watch what the wealthy do instead, step by step. Step 1, buy. They acquire assets that appreciate over time, mostly stocks, businesses, and real estate. Nothing exotic yet. A founder builds a company, an executive accumulates shares, an investor buys property. The key is that they almost never plan to sell because in the American tax system, and in many others around the world, unrealized gains, meaning the growth of an asset you haven't sold yet, are not taxed at all. Your stock can go up $10 million this year, and your tax bill on that growth is $0. Zero. So a billionaire's wealth can explode year after year while their taxable income stays tiny. But wait, you're thinking they still need cash to live, right? Mansions, jets, groceries, whatever billionaires buy. If they sell stock to get that cash, boom, capital gains tax, up to 20% federally plus state taxes. So how do they get cash without ever selling? That's step 2, borrow, and this is where the magic trick happens, so lean in. Instead of selling their assets, they walk into a bank and use those assets as collateral for a loan. It's called a securities-backed line of credit, an SBLOC. Think of it exactly like a home equity line of credit, except instead of your house backing the loan, it's your stock portfolio. Banks love these loans because if anything goes wrong they can seize and sell the stocks instantly, so they offer them with easy approval, flexible repayment, and interest rates far below what regular people pay on credit cards or personal loans. Major banks will typically lend somewhere between 50 and 70% of a portfolio's value this way. And here's the sentence that changes everything: borrowed money is not income, so it is not taxed. Not a single cent. Let that sink in with a real example. Say someone holds $5 million in stock they bought years ago for $1 million. If they sell, they owe capital gains tax on $4 million of profit. That could be $800,000 or more gone to taxes, depending on the state. Instead, they borrow $2 million against the portfolio, pay 0 tax on it, and their $5 million stays fully invested, still growing. The interest rate on the loan might be lower than the tax rate they avoided, and often lower than what their portfolio earns each year. They're essentially being paid to not pay taxes. And this isn't some fringe tactic. Morgan Stanley alone reported over $68 billion in these security-based loans among its wealth management clients, a figure that doubled in under a decade. The total SBLOC market has been estimated at roughly $138 billion. Here's a metaphor to lock this in. Imagine your wealth is a golden goose. Normal financial advice says when you need money, sell the goose or at least carve off a piece of it and pay tax on every slice. The wealthy never touch the goose. They walk into the bank, point at the goose, and say, "Look how golden this goose is. Lend me money against it." The goose keeps laying eggs, keeps growing fatter, and the tax man, who can only tax a goose when it's sold, just stands there watching. Okay, but you're probably asking the obvious question, don't the loans have to be paid back eventually? What happens when the borrower gets old and the loans have piled up for decades? That's step 3, die, and this is the part that genuinely shocks people because this is where the whole machine pays off. There's a rule in the US tax code called the step-up in basis. When someone dies, the cost basis of their assets, meaning the original purchase price used to calculate taxable gains, resets to the market value on the day of death. Read that again. All those decades of gains, the millions, sometimes billions in appreciation that was never taxed because nothing was ever sold, it just evaporates for tax purposes. The heirs inherit the assets as if they were bought yesterday at today's price. They can sell immediately and owe zero capital gains tax on all that lifetime growth. The estate pays off the outstanding loans from the assets, keeps the rest, and an entire lifetime of investment gains passes to the next generation without capital gains tax ever being collected on it. Let me make that concrete with numbers because it's almost too strange to believe in the abstract. Imagine a founder whose shares grew from $1 million to $100 million over a lifetime. If they sold the day before dying, the estate would owe capital gains tax on $99 million of profit, roughly $20 million or more depending on the state. If instead they simply held and passed away, the heirs receive the shares with a cost basis of $100 million, the current value. The $99 million in gains is never taxed as a capital gain, not by the parent, not by the child, not by anyone, ever. Same asset, same growth, same family, and a $20 million tax bill decided entirely by one thing, whether a sale happened before or after a heartbeat stopped. Buy assets, never sell. Borrow tax-free cash against them. Die and the tax bill dies with you. That's the machine. And notice how the 3 steps protect each other. The buying builds the collateral. The borrowing provides the lifestyle without ever triggering a sale. And the dying erases the scoreboard right before anyone has to settle up. Remove any one piece and the machine stalls. Together, they form a loop that can run for generations, which is exactly why old money families guard their assets so fiercely. The asset itself is the engine. Selling it is the only real mistake. And if you think this is theoretical, let's talk about how visible it is in the real world. Elon Musk has publicly pledged Tesla shares as collateral for personal loans. It's disclosed right there in company filings for anyone to read. When billionaire wealth gets debated in the news and people ask, how can someone worth hundreds of billions pay so little in tax? This machine is usually the answer hiding in plain sight. The top federal income tax bracket sits at 37%, long-term capital gains top out around 20%, but a securities-backed loan can often be had for less than either number, so for the ultra-wealthy, borrowing is simply the cheapest door in the building. And it goes beyond stock portfolios. The ultra-rich borrow against art collections, private business equity, real estate empires, even intellectual property. Private banks build bespoke credit lines wrapped around a client's entire balance sheet. One wealth advisor described helping a client buy a $4.5 million home using a securities-backed line instead of a jumbo mortgage, at a rate more than 2 full percentage points below market mortgage rates. That was $90,000 saved in interest in the first year alone. Notice something else. Banks aren't the victims here. They're enthusiastic partners. These are some of the safest loans a bank can make, liquid collateral they can seize and sell in seconds. The bank wins, the borrower wins, and the only party missing from the table is the tax collector. Now, before you get angry, or before you get too excited, let's be honest about both sides of this, because I'm not here to sell you a fantasy. First, this is completely legal. It's not a loophole in the shady sense. It's the direct result of 3 ordinary rules interacting. Unrealized gains aren't taxed, loans aren't income, and inherited assets get a stepped-up basis. Each rule exists for a defensible reason on its own. Together they create this. Politicians have proposed changing pieces of it for years, taxing unrealized gains above certain thresholds, capping the step-up, and those debates continue, so the rules could change in the future. That's a genuine risk to the strategy. Second, it's not risk-free even for billionaires. If the market crashes hard, the collateral shrinks, and the bank can issue what's called a margin call, demanding immediate repayment or forcibly selling the assets at the worst possible moment. That's why, even though banks may lend up to 70% of a portfolio, Wealth managers privately advise clients not to borrow more than about 25% for long-term loans. They leave a huge safety cushion. And rising interest rates can squeeze the whole equation. When borrowing costs climb, the gap between the loan rate and the avoided tax narrows, and the strategy gets less attractive. So no, this isn't free money. It's a calculated machine with moving parts. But here's what I really want you to take from this video, because most people watching will draw exactly the wrong conclusion. The wrong conclusion is, great, so I should go borrow against everything I own. No. If you're living paycheck to paycheck, carrying credit card debt at 20+% interest, this strategy is not your next move. Your next move is killing that toxic debt, because it's the exact mirror image of what the rich do. They borrow cheap against growing assets. You'd be borrowing expensive against nothing. The right conclusion is the mindset shift underneath the strategy, and this part applies to you today at any income level. The wealthy organize their entire financial life around one principle: own things that grow and avoid interrupting that growth. Every piece of buy, borrow, die serves that principle. So here's your actionable version in order. First, before anything else, become an owner. By appreciating assets, index funds, a home, a business, stock in great companies, consistently every month, for decades. You cannot borrow against assets you never bought, and honestly, 90% of the benefit of this whole philosophy comes from this step alone. Second, stop interrupting compounding. Every time you sell an investment to fund lifestyle spending, you trigger taxes and you kill future growth. Here's the hidden cost people miss: when you sell and pay tax, you don't just lose the tax money, you lose every dollar that tax money would have grown into over the next 20 or 30 years, and that number is usually several times bigger than the tax itself. The rich treat selling as a last resort. You should too. Before selling, ask, is there another way to fund this need? Third, learn the difference between destructive debt and productive debt. Debt that funds consumption at high interest makes you poorer. Debt that's cheap, secured by growing assets, and smaller than the growth of those assets, can make you richer. Same tool, opposite outcomes, the only difference is how it's wielded. And fourth, when your assets do become substantial, know that smaller versions of these tools exist for regular investors. Home equity lines of credit work on the same principle with your house. Many mainstream brokerages offer securities-backed credit lines at surprisingly accessible account sizes. People have used them for things like bridging a home purchase or covering a surprise expense without selling in a down market. Used conservatively with that 25% cushion rule, they're the same machine at a smaller scale. Used aggressively, they're a margin call waiting to happen, so respect the tool. Look, here's the truth that stings a little. The financial system has two rulebooks, and nobody hides the second one. It's sitting right there in the tax code, in public filings, in wealth management brochures. The difference between the people using it and the people complaining about it usually comes down to one thing: financial education, which is exactly what you just gave yourself in the last 10 minutes. You now understand something that most people will go their entire lives without understanding: that wealth isn't about how much you earn, it's about what you own, and that the tax system rewards owners, not earners. You can be frustrated about that, and honestly, some frustration is fair, or you can be frustrated and act on it at the same time. So here's your move for tonight. Look at your finances and answer one question honestly: am I currently an earner or an owner? If the answer is earner, your mission starts this month. Automate your first or your next investment into an appreciating asset, even if it's $50. Because the machine you learned about today only works for people who own the golden goose, and every goose, every single one, starts as an egg.